Well, welcome back to our show. As we were talking about the separation and the preparation, of course, I will happily steal Russell Wilson's lines and use them going forward. It really does ring true, though, when you're working with professionals, the amount of work that they put in before they meet with you, the amount of preparation they do will yield by far and away the best results. We have a great friend of our show, joins us consistently. Dennis Gibb is back with us, president of Sweetwater Investments, a company he has successfully grown for over 20 years with $1.4 billion in assets managed. Dennis, my man, how you doing?
I'm great. Happy New Year.
Happy New Year to you. Your experience would show that and I know you spend a lot of time not necessarily working with clients, but preparing and learning and understanding what's going on in the markets, how to help people more. I'd say you're the epitome of it.
Well, in our business, if you're not learning, you're dying. You have to constantly learn. One of the things you have to be careful about, however, and we'll talk about later, is the amount of information you take in and sorting out the information you get. Strangely enough, not all information is equally good. Mm-hmm. So you have to sort it out. But we have to read constantly. You're constantly looking at new ways of doing things, people's perspectives on things, what people are saying. You have to prepare. We live in a complicated world. You have to prepare. If you can't prepare, you're not going to succeed. It's just that simple.
Do you think, as a professional, you prepare? But when a client comes to see you, they also need to have some preparation in order to make a meeting successful, don't they?
Oh, if they would only do that. We spend a good deal of time helping the clients get organized, finding their statements and finding the various things that they're going to need to make the financial plan. But yes, it would be nice if they would prepare too. But part of our job is to help them sort out some of the goals and what their beliefs are so that we can make the plan around it. And that's something, that most people are still confused about. You can get all the facts right. It's some of the intangibles that are difficult to get in place.
And that's really where you can help somebody prepare, I would imagine, to understand maybe what those values are so that you can make, maybe it's investments around those values, maybe you're setting goals around those values so you're not just throwing investments at the wall to see what sticks.
Yeah, that's exactly right. I mean, it doesn't work unless the client can believe in it. So if you have a client who's arch conservative and you're going to propose a rapid trading strategy, it's not going to work. They just can't get into it, and vice versa. So you have to understand the client. You got to do a little preparation of what they're thinking about and all that sort of stuff, and then you hopefully you can find a philosophical common ground where you can work with them. If not, as a professional, you have to be honest enough to tell them that they need to go someplace else.
Well, preparation is really the reason for, I'd say, doing well in the future.
Right.
And, what do they say? Success is when opportunity meets preparation or something along those lines. Yeah. You usually know those. You usually pull those out. I figured you pulled that out for me. But, Dennis, looking forward, are there big trends that you're prepared for in 2013 when it comes to the investment world?
Well, I think there's big trends in 13. There's big trends going on that'll go past 13. One of the silliest things that happens at the beginning of every year is when stock market prognosticators get out there and they start telling you where the S&P is going to end at year. That's got the same chance of winning as roulette. It's silly, but there are some broad trends that have been going on, and the first one is that for years and years and years, people invested in mutual funds. And 401ks were all about mutual funds and modifications thereof. And mutual funds have a lot of problems associated with them. First of all, high fees. Second is the governance of them is not particularly good. You don't know who to complain to. They also have some tax implications. So back in 1990, a group of people up in Canada came up with an idea called the exchange-traded fund. And I would say that the exchange-traded fund has probably been the most successful investment product ever created. It has gone from zero to about $2 trillion in assets in ETFs since 1990, which is pretty remarkable. This has offered people an opportunity they've never had before. You can invest in China through an ETF. You can invest in Japan. You can invest in Indonesia. You can invest in coal. You can invest in anything you want to through an ETF. And the fees are fairly low in most cases. So, it gives you most of the benefits of a mutual fund in that you get diversification. It offers you lower fees in a mutual fund, which is always a positive. You can do all sorts of strategies with them. And it allows you to overcome something which most people and most professionals don't want to admit. And that is most people, and including most professionals, are lousy stock pickers. And if you're depending upon them to find some stock that's going to put your kids through college, you've got about a 1 in 3 chance of having that happen. So ETFs offer you a way to diversify your portfolio and get market returns at low cost. There can't be anything wrong with that.
And that low cost is such a key to this, right? Because a lot of those mutual funds, the first 3, 4, 5% of maybe your earnings can go to the mutual fund. How do you think they build those skyscrapers in New York, Dennis?
Exactly, and that's what it's all about. It's all about gaining assets, and that's how they build all this stuff, is by getting fees. And so they'll do anything to get the fee. The way you get the fee is performance, which means that they're going to do whatever they can do to get performance, which means they may not be working for your best interest. I know that's shocking that anybody in the business wouldn't be working in somebody's interest, but that's the way it works.
Since they probably don't know you either.
They have no idea who you are. And, I mean, you think the guy running Fidelity Magellan has any idea who he's talking to? The other thing is that ETFs, I mean, give you an example. If you want to buy an ETF that invests in large cap stocks like the S&P, with an ETF, you'll pay 0.07% a year. If you do it with a mutual fund, you'll pay 0.17. So the difference is fairly large, and you'll get the same performance. You know, we call it tracking error. If you're not paying as much fee, your tracking error, your difference between your fund and the S&P will be closer, which is exactly what you want to have happen. So there are risks to these things.
Sure.
There's some crazy ones out there, and you got to be really, really careful about what you look at. But you know, if you're going for some of these things that emulate, that buy the entire index and they just emulate it, those things are really safe and they're cheap.
And it seems that would be a way for somebody who maybe wants to do some of their own investing to get into the market in a very diversified way without a lot of fees.
Well, I tell most clients that the majority of their assets, probably 60%, should be invested in a series of index-related ETFs that cover most of the broad asset classes, large cap, U.S., mid cap, so on and so forth. And that should just be their core portfolio, and they should rebalance that occasionally, but that should be their core. And then they should go out and just screw around. If they want to screw around with the remaining 40%, they can do that. That's where you're going to get your big gains if you're right. The rest of it's just going to continue to crank along as the markets do. And over time, you'll outperform almost everybody.
You talked a little bit about, finding somebody to help you, but then you help you with these investments and find these different investments to put your money into, whether it's at a 60-40% ratio, whatever it may be for the right person. But are people kind of shying away from the brokerage houses or the investment professionals? Does that seem to be a dying breed in some ways?
Well, I think you're saying two things which are contradictory. People are shying away.
That's what I do. That way I can't be wrong.
Yeah, I mean, you're in the mortgage business. I mean, we know all that.
You're not gaining a debt. You're buying a house.
Buying a house. That's exactly right. And putting yourself in chattel slavery to a bank. But anyway, the brokerage houses, as we knew them, at least through my career, they received a death blow in September of 2008 when Lehman Brothers failed. Now, most of the brokerage houses that everybody identifies, Dean Witter is part of Morgan Stanley. Morgan Stanley is now a commercial bank. Merrill Lynch is owned by Bank of America. All the brokerage houses that we knew are owned by bigger organizations. They are dying off because people have been literally hosed by these brokerage houses for years because the brokerage houses put their own interests in front of the clients. So assets are fleeing from those brokerage houses. Almost every new account we get at Sweetwater is coming from a brokerage house, a traditional brokerage house. The advisors are fleeing from those firms too and setting themselves up. And part of this is also a technology thing. People ask me how many people I have working for me, and we have $1.4 billion. You can do that now with 5 or 6 people. 10 years ago, you would have needed about 50. Technology has made it so much easier. So these brokerage houses don't have the control that they used to have over people's money. I mean, when I got started, what we were was information disintermediators. Okay, I know Tuckwell, they're having a hard time with that, but you knew I was going to get a Tuckwell joke in here, didn't you?
I did, right.
What we did was we had information. We were the only place you could get it, and what we did was sell that information. If you wanted a live quote, a real quote on the New York Stock Exchange, you had to come to a brokerage firm. There was no other way to get it Okay, now you can get this on your phone. You can get it anywhere you want. That information is gone out. So the technology, we're not selling that anymore. What we're selling now is our ability to take the information that's out there and make that into a useful whole. Now, you can't do that if you're bound by the rules and regulations of some monster, ponderous bank that, can't find its rear end with both hands. Okay, you've got to be independent. You've got to be a thinker, and that's why these brokerage houses are dying off. People, now you talk about financial professionals. The other side of it, people need to start recognizing that the difference between a broker and a fiduciary. And a fiduciary's only standard is what's best for the client. The broker, their entire standard is it suitable? It sounds like a distinction without a difference, but it's not. Brokerage houses, if the interest of the house comes before if the house is in danger, the interest of the house comes before the interest of the client. On the other side, it's exactly the opposite. The interest of the client comes ahead of the financial health of the firm. So there's a difference. There's a difference there, which is very, very important for people to realize. And that's why brokerage houses are dying. They have not adapted to the new market concepts out there, and they're dying, and they deserve to.
Dennis, we have to go to a quick break, but let's come back. I know you have some more things to look forward to in 2013 that people can prepare for. I'm Ben Brash, and you're listening to Dennis Gibb on Brashnomics. We'll be right back.